combination punches. This killer risk is, well, most companies only look at one at a time risk events. Even many companies with ERM programs, they really look only at one at a time punches. But it's important to look at combination punches. There's a research study I often quote by Deloitte Research called Disarming the Value Killers. And what they did was they looked at a 10-year period in the stock market, and they picked the largest market cap drops and called those value killers. And they examined the sources of the risk that caused those massive market cap losses, and they found that 80 or 85% of them were the result of two or more risk events occurring together. So many organizations may say, well, we've looked at all our risks and there's no one thing that can really hurt us. That may be, but it's often in the real world, multiple things go wrong at the same time, and the biggest disasters is often combination punches. And it's really, aside from the research, it's also intuitive. A boxer maybe can take one big punch on the chin, but it's often two combination punches in rapid succession, and maybe even moderate. One punch knocks them back on their heels, and the next one, and they're out. And the same thing with companies and people we know too. We may know somebody that, God forbid, they lose their job, and then somebody in their family dies in rapid succession, bang, bang, and then they spiral downwards psychologically. We've seen that, and so it's intuitive. So we must look at combinations of two or more events happening at the same time. The case study here that I want to talk about is financial crisis. So, this raises another issue also, that the financial crisis, many people think it's a financial source of risk, and obviously there were market movements involved. But actually there were three main sources of risk that, in my opinion, caused the financial crisis more than any unusual movements in the market, and they were all operational risks. And by the way, they're all actually still in place. So this gets to another important issue in enterprise risk management that we address in the Columbia University Enterprise Risk Management Program, is the focus on sorting out what is a true source of risk rather than the outcome. And there's often a muddling in companies between the two. So now I'll get back to the three different operational sources of risk that contributed to or caused the financial crisis, in my opinion. The first one is agency risk, and this is a mismatch between bank management and bank shareholders. A mismatch of incentives, and as it turned out, it was also a mismatch between the management and taxpayers, because taxpayers ended up bailing out the banking sector. What's the problem here is that there's three things missing to allow a connective tissue between the shareholders and management using enterprise risk management. The first is you need to measure risk exposures on the basis of the impact on value, the full value of the organization, all the future cash flows. Most banks do this only on a capital basis, a short-term basis, and only on the capital in the balance sheet. That misses a lot of important numbers. There's a way you can destroy the value of the bank where the capital ratio is still fine. So this is very poor and suboptimal. Secondly, you need to integrate that information on risk exposures into the business performance evaluation, including an attribution down to the individual level. So we can actually quantify and see how much an individual or an individual's act or a unit's act or a department's act is actually increasing the exposure of value. And the third thing you need is to integrate this information on risk exposures into incentive comp. So first you have to measure the right thing, value. You have to be able to look at risk exposures on an attribution down to individual actors. And third, you have to put it in incentives so that those incentives are then aligned. So you have to get the information and then connect connective tissue to the incentives of the shareholders. A second aspect, operational risk, was process risk. And I have 10 ERM criteria that I think are critical to really evaluating whether an ERM program is robust. And these 10 key ERM criteria, when you look at banks, I see that they are actually missing the vast majority of the 10 key criteria. So their ERM processes, which is process risk, are suboptimal, and that contributed to the financial crisis. The third operational risk that caused the financial crisis is mispricing. And this is people, human resources risk, that's an operational risk, people actually not doing their job properly. So there's two different aspects of the mispricing. The first was that the banks mispriced the CDO default risk. So the CDO is a collateralized debt obligation, and the way to think about this is that, think of it just as mortgage risk, very simply. So there's a complex instrument. So there's a shortcut that banks use that involved a formula called a copula. We're not going to get into the details of that. We don't need to know what that is. But they use a shortcut called a copula formula to infer what the default risk was in that CDO. So if the CDO is a combination of certain types or slices and dices of mortgage risk, so how much of the risk of default is in this bundle of risks? What they did was they said, well, we're not going to go in and figure it out. We're going to actually use a shortcut, which is there's CDSs on the CDO. So what is a CDS? A CDS is a credit default swap. So a credit default swap is like an insurance policy on something. So if you were worried that an entity was going to fail and you own part of it, you could buy a CDS on it, which is insurance, that if that entity fails, the CDS, you get paid money. So if you have insurance on something and the insurance is traded in the market, you can see what the market thinks of the risk of that entity failing. So there were CDSs on the CDOs, and there's a lot of letters here, but there was insurance tradable in the market on this mortgage risk, and as that market price went up or down, they said, well, we're not going to do the hard work of looking at the individual underlying mortgage pieces here, which is very complicated. We'll just infer what that is from the CDSs. And there's an article, if you're interested, a very good article called "The Secret Formula That Destroyed Wall Street." It was a cover story in Wired magazine, and what the problem was is that they only used a 10-year period. Historical period to look at the market prices, because CDSs didn't exist for more than 10 years. So, and that 10-year period just happened to be only a period of rising housing prices and nice interest rates. So if you look back at a previous period, certainly you've seen a lot more ups and downs, and that's what ERM teaches you, how to look at a reasonably long historical cycle of making your estimations for these types of risk. They made a classic mistake, is just not looking at enough up and down periods, and their risk assumptions were very poor. So they mispriced the CDO default risk. They also, a second aspect of mispricing was they mispriced the CDS insurance risk. So the credit default swaps are insurance, and bankers were getting into an area that is more insurance, and actuaries are experts on that risk, and they didn't really understand that risk, and they didn't do what actuaries typically do, which is, well, we set up a reserve for that risk, and then we have regulatory capital we have to hold as safety net on that, and then actuaries typically hold multiples of that on top of it. So we have a lot of extra capital that bankers basically ignored. So certainly it looked massively profitable, but it really wasn't, and then it blew up. This next case study is about Fukushima. Now, the Fukushima nuclear disaster in Japan, it was really interesting. They had planned, the risk folks had planned for an earthquake. So the nuclear plant was safe if an earthquake would happen, if everything was working well, which actually it wasn't. And they also separately planned for a tsunami. If a tsunami happened, they'd be fine. But they didn't plan for the combination, which is astonishing, because even though most tsunamis are caused by earthquakes, so how they could avoid it, I mean, that's what I heard, that they didn't plan for the combination. So we discuss in the Rainmaker killer risks segment, we talk about that there were also other major risk governance issues. So as you can see, there was a lot of combination of things that worked together to cause the disaster at Fukushima. So possible mitigation, how can you possibly deal with this difficult problem? Well, you can address the interactivity through the ERM process in three ways. First, you can have a robust risk scenario development process. You can look at risk carefully by their originating source, trace them through all the actions that would occur if that risk source trigger would occur, and you can develop these deterministically using a failure modes and effects analysis process to interview subject matter experts, and this draws information out of their heads and gets realistic, real-world scenarios of how they would play out and how they would play out at your particular organization, which is very important. And what's also important is when you have an individual thinking it through, sometimes you'll see that one risk actually would rise to a level that would actually trigger a second risk, and you'll capture interactivity that way directly in the risk scenario development itself. The second way to capture an ERM is in a quantitative model, where you can actually combine multiple scenarios together and just see brute force how they interact. Do they exacerbate? Do they offset? Which ones are more important? And third, correlations. Very simply, these are adjustments that are made in the ERM quantification process for the fact that some risks are more likely to occur than others together. So hopefully you enjoyed the killer risk segments that we've shown you, and it was fun and interesting, hopefully, and it gives you a little bit of a glimpse of some of the material that we cover in the Columbia University Enterprise Risk Management programs. So hopefully you enjoyed it. If you're interested to find out more about the program, you can go to this website where we have information on the ERM Master's Program as well as the ERM Certification of Professional Achievement, which is a 4-course. We have the full 12-course Masters, the 4-course Certification ERM, or how to take individual courses on a post-baccalaureate basis. Or you can email me. My email is here. You can reach out anytime, and I'll be happy to walk you through our ERM program and why it's unique. And again, the 3 advantages are that we cover all ERM processes. We handle all sources of risk, really holistic, and it's a very practical approach using faculty that are ERM experts that are active in the marketplace, as well as building in communication and business interaction skills so that you will be successful in a risk and ERM role.